Bush said houses for everybody, robo signing, strippers with 8 or 9 properties at Vegas were landladies with huge portfolios that barely put 5% down on each one. You know, whole shebaggle. Guys quit jobs to be Miami apartment flippers, you name it.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Francis Hunt joins us today. Better known as the market sniper, Francis Hunt built the Hunt volatility model, which offers traders a unique and technical approach to trading in all markets. His views on gold, silver, Bitcoin, crypto, geopolitics, and more have made him a favorite and sought after speaker and guest. And we're delighted to have Francis join us once again today. Time to saddle up and silver up for Francis Hunt. Francis, welcome back to SBTV. How are you doing?
Great to be back with you, Patrick. Delighted to be on your channel again.
Glad to have you back on because last time you were on, you had said how gold was knocking on that door to break through that $2,000 level. And you were right, my friend. So much so, we saw gold hitting new all time highs and now getting close to that $2,500 per ounce level. Do you see that $2,500 per ounce level maybe coming about this year?
Well, I think there's a chance we could even get 2,900 this year still. There is a chance. Um, we're seeing a bit more dollar weakness recently. And, just going back to framing, people should save in dollar ounces. You know, how many dollar ounces you get, how many dollar ounces do you have? And each month pick up a few more dollar ounces. That's the way to do this, because this is the gift that keeps on giving. You know, I looked at copper, silver since 2000. Actually, gold is the best performer. Silver had outperformance in 2011, but was quite a short time frame, chronically overperformed, spiked and came down, but has lagged gold a bit still. Copper had a small spell of outperformance during the subprime run-up boom before the subprime crisis, with all the building going on. But again, it was a small segment of the time. Most of that time, that orange line was the best performer and it had less volatility. So the reason why I say go back, and I'm a silver bull, by the way, and I'm a commodity general bull, but if we have demand destroying events, things that have a higher level of industrial use, like copper, which turned down quite violently recently, are going to head lower, while gold's downside volatility is not particularly high. And we saw it in March 2020, it was back all in the same month, to where it dipped from. And this is the value. And people don't tend to adjust the volatility, they just look at outright returns. So, gold. I'm actually thinking I overbalance because I have about 50% or maybe 40% silver by value. You have to have quite a lot of it to have half of gold. And I'm kind of thinking now, I would have been better served if I'd been 75-25. I don't think I want to be caught ever out of silver in terms of the precious metals. And funnily enough, I do have a bit of platinum, so it's not exactly 75-25, but by value, I would say close enough. But actually, I would have been better served on outright growth, and more importantly, that most people don't discuss, volatility adjusted. I would have had greater stability if I'd been 75-25. So I suppose I'm always self-assessing my own performance, and they're both up. How can you do things better? Where, the quality of your life, Patrick, if I'm going to take a small sidebar and I suppose climb on my soapbox. This is what someone taught me, and I'm now just repeating, because if I can pass that message on and it serves anybody, anyone else that's strong, is the power of the questions you ask yourself of yourself. If you say, "Aren't I smart, clever boy, everything up, I've made X%," that's kind of a gloat. It's kind of self-contentedness. It's in the box of pride in the 7 great sins. Actually, even when you've done well, how could I have done better, is the kind of thing that then sees me doing cross analysis and actually saying, The God market moves first, and it's gold. So I should have been more dominant gold and less dominant silver. You should always be asking at what when we enter trades, where am I going to be wrong on this? What's the price point that I get out? All of these kind of questions. So instead of, even though it's moved in your favor, instead of going woohoo, I'm making money, it's always got to be you've always got to be checking yourself, checking your own ego, checking your own pride, and asking how can I be better, and how could I have done better. And my answer to my recent performance analysis is weightier gold. This is, and what do I conclude from that? And what's interesting from that is that this is going to be probably the longest, most significant precious metals move of them all. And the initial phase, which is a gold dominant phase first, before you get that surge of metals of silver and the others like platinum and all of them, gold driven, and the central banks are the buyers and they buy gold. They don't chase platinum up, they're not chasing palladium up, they're not chasing silver up for storage reasons, etc., etc. And the others almost for scarcity reasons and very thin markets and liquidity reasons. Gold just is the right balance of high value, density of value in storage, sufficient proliferation, but rare enough. And it is the chosen one, and you should start there. And it's been ironically, and I don't mean to conflate crypto land with the precious metals. One is the far larger, more significant market to me, but it's very much the same. Outside of one or two tokens, Bitcoin has been the Bitcoin dominant. It's gone from about 37% to about 55% in its dominance. You have to start with the first one to run, and it's the boss. And gold is that. So it's ironic to be using Bitcoin as the analogy because this is a 15-year-old analogy to the multi-millennia analogy, but actually people don't play this life stage cycle that we are in. They play tomorrow. Everybody, if you ask people, if you ask a wise man how to be happy, it's because how do you become happy? Is you to stop looking for happiness in tomorrow, be happy today, in the moment you're in. That's how you become happy. It's a fleeting moment of awareness in that very moment. And in the bull markets of precious metals, be positioned for today and the phase that you're in, not in the phase of tomorrow. One day when I've got $100 million, $10 million, a fast car, three houses in three different continents, and 5 million in precious metals. No, 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 no. Where are you now, and what stage are you in now? And play the ball that's being pitched to you today in the here and now. And my adjustment, if I were doing this again to be better, is recognize this is a bigger cycle. We all have to be more patient. We're all playing tomorrow's pitch when the ball is whizzing past us right now. Be in stage one, gold dominance, Bitcoin dominance if you're in crypto, and that's where the game's been. So yeah, I suppose quite a long-winded answer, but an interesting one, and one that's come just after a bit of self-reflection on how you can do better.
If you're enjoying this interview with Francis Hunt and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, when you store with us, you can use your bullion as collateral for a secured loan? Silver Bullion's peer-to-peer bullion secured loan program has enabled people storing with us to have made some 600 million plus US dollars worth of loans with zero defaults. To find out more, go to www.silverbullion.com.sg and click on the P2P loans tab, or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. Yeah, no, that's a great answer because I think a lot of times we get stuck on the price points, the ratio, all of these things, and I mean we should have, of course, be taking a look at these things, but be in the moment. I think that's something maybe we do miss because even even my next question was going to be, between gold, Bitcoin, silver, and maybe even platinum. Where might we consider being in? But I guess you answered that: gold and Bitcoin.
Largely initially, and we are in an initial cycle. I would say the crypto cycles are definitely a lot smaller, and the bull runs potentially more regular and tighter. What tends to happen is we get impatient. Play stage one when in stage one in metals. Stage one is gold dominance. And let's do something on a chart and show you a little bit of that actually. I think you'll appreciate it. So if I'll do the futures gold C and grab it, and we'll put all of these on one chart. Let's take a look at the screens, Patrick, so that we can enjoy a little look. It might help with that relative strength question that you were mentioning. And let's see that. Are we showing well?
Yes, yes.
Great. So if I've just put up gold up there, and I'm going to add gold so that we get the orange line on it. I'm going to add same percentage scale silver, and let's just put an industrial one like copper on there as well. Silver in blue, copper I'm going to change to something a little more pink because it's kind of got it's what makes the rose gold rose. So we'll put him in there, the pinky bit, and then we'll give silver a bit more thickness as well for visibility reasons. But I was just doing this with my community. If you've taken from the lows of the previous bull run to 2011, there's your bit where silver absolutely blows up and dominates and wins. But it really only starts here. And actually, it's correcting in terms of performance, it's correcting violently there. While the gold chart, the candle one, is actually the highest one today since the 2000 lows. I'm going to also just make that orange line a little bigger so it really pops, so that they all have a line chart with it as well. You can see it quite clearly, the orange line. So you had a small period of overperformance of silver, but it was actually below the collective performance since the beginning of the 2000 lows quite quickly there. And it was actually coming down. You would have wanted to have got out up top here somewhere if you'd called the top, because its high beta nature actually saw it correcting a lot faster during this period. So actually, you're only really dominating for that small time period. And if we look to where we are today, you're at an 806% from the 2000 lows on gold, and you're on a 562% on silver. And the industrial metal is turning down quite hard. That's the copper, that's at 453, and is less good for preserving against inflation, debt collapse. The monetary metals are outperforming copper, but which is purely industrial. But silver is kind of in between the industrial and the monetary metal of gold, and that's because the central banks are not going to buy silver; they're going to buy gold and the small industrial element of it. So actually, gold is your guy. Now, at some point, that pivots and changes, and we've been an avid watcher of the gold silver ratio, and we did get some movement on that. So, obviously, this is very dependent on the framing that you're looking at time wise. 2000 was a long time ago. We were all, younger men and ladies. So, if we go back to the last relative high, that does change a bit. I'll drop it to a weekly, and I'll just take us to the 2011 high. If we go back there, and we're on a weekly chart. So it does matter if you take a localized high or low. If you look at that from the highs of the last bull market, silver corrected quite violently. It's the blue line. Copper actually held up better than silver, but gold is gold and has done what it's supposed to do and is still the winner. So at relative highs, because of the high beta nature of silver, that sees it go up faster in bulls but correct harder in bears. Because we're starting at a bear market, its base gets reduced really low before it started to come back. So that reflects silver in quite a bad light. So many people might have bought into silver, approaching the 40s, the upper 40s level, then you're still 31% down. If you bought at 47, which would be a very unfortunate entry, but nonetheless, it's worth pointing out. And then if I put it at the lows again, which is catching the bull market up from around 216, so that was a crisis. Many people don't realize 2016 was a crisis year, much like 19 going into 20, much like 07, 08 going into 09, which was a depression as far as I'm concerned, not a standard recession. And what's kind of interesting in this is that you can see silver's actually done pretty good and is above copper once you take it from the recent lows. So it's got a little bit more of the gold over performance element in it, but the winner is still gold from the lows of 2016, the Shanghai Accord events. And then if we go to the localized highs of 2011, which was those highs, you can see precious metals went sideways, silver and gold, and actually copper's off the chart because we've got property, building, industrial need, who knows, AI, robotics, whatever the case may be. So here it reflects copper in a very favorable light on a relative performance from the highs, but we're catching precious metals at their worst moment because they went down strongly. So it's interesting looking at these correlations in these different time frames, and you've got to be very careful about when you jump in. And if we now go back to the last current move up, which is November, when we started to break out, and gold got above 2000. So this was the low before gold got up above the 2000. You can see the gold chart, and again, still in the candles. That was our wind-up call at the 2000 mark. You may recall that. That's when you broke out, that reference you were talking about, 2000. You can see that because we're in a bull phase, actually silver's the best guy so far. But we're getting into a corrective phase in copper. So I'm going to tell you why I've dragged copper into this discussion with you, Patrick, and for your audience sakes. And this was something I've just done, and I'll be releasing a YouTube on it, but you guys can have a little bit of a debut check out on that side. I will show you this. I hope this is showing you my screen still. I've prepared a chart there. So what I've done is I looked at copper and said, is copper then one of the most natural, because of infrastructure expenditure, it's a wire that's in construction of everything. Is it not physical economic activity, one of our best? Because we sometimes use oil, people flying, traveling, buying goods, delivery, plastics, etc. And also there to a degree, building, the copper is one. And I said, well, I want to reduce the copper chart by inflation. So I divided it by CPI CSL. Wasn't happy with it. It took it down from its highs a little bit, but it still was the copper chart. And I said, well, the stats that you get aren't accurate. What about if I deflate copper by the inflation hedge, which is about true inflation, and also the fear of debt collapse, which is gold, because people sell treasuries for gold a la China. And the big movers are indicative of what they do. And that means their fear of debt sees them divest from debt and accumulate gold. So I took copper as an economic building activity benchmark, its price, and I divided it by gold. And here's what I got. Generally, we are in a regressing economy. That means one that is constricting. Every new dollar of debt is not a beneficial dollar. Let me just bring that back up. I have it in full screen mode, so it won't allow me to also do, I'll just make it a bit bigger. I want to be able to draw on it. So you can see there's a regression line I've made that goes like that. The lower highs and lower lows. Plus, there's one super event, and that's why I refer always to the subprime event as a depression, even though it's not been acknowledged. I think in future history books, retrospectively, they'll acknowledge, because we had bank failure, we had over 2 years of negative growth, even though one or two nations just pushed through naught in one of the quarters, just so that you didn't get the 2 years of contraction, which is the definition of a depression. bank failures is another part, large scale bank failure. We had it all. It was a depression, in my take. Some will argue, but that will be what it is. It's a technical element. We had a super boom before the depression that added spice to the downside, which was the super low interest rates after the dot-com recession. So we had a dot-com recession. We dropped rates super low in the States. We then got a mega housing boom. Bush said houses for everybody, robo signing, da 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 da. Strippers with 8 or 9 properties at Vegas were landladies with huge portfolios. They had barely put 5% down on each one. You know, whole shebaggle. Guys quit jobs to be Miami apartment flippers. You name it, it's all happening. Super overshoot of this regression mean line that I've imposed here. And what do you get? A super undershoot to the downside, the depression. Then every other aspect, you had the dot-com recession, you got a little bit of an echo recession because the depression was so big. It's kind of like a huge earthquake. You get a post tremor. They did QE, they did everything they could pull. One, two, twist, all of it happened, and it still wasn't enough. And after a while, when they stopped doing it, they started pulling the programs, you slump back down again. So I call that sort of the echo recession to the major depression that was subprime. That's in pink, by the way. Now, the interesting thing is this is still the copper price, only it's copper divided by gold. And what you can see each time, Patrick, is in the yellow zone here, roughly when we crossed our regression line, you had a major downswing below the regression line. That was a depression. Here, this one is an anomaly because we had such a super boom, but that is a depression, a huge, huge move. So we were extensively above. We had this unbelievable economy, the miracle economy, everyone so rich and flush, into the absolute morbidity that was 2009, 10, 11, and 12. Then we got the echo recession. Again, you went above the regression line over here and you broke down below it with strong momentum. Here again, a little bit above, a little bit below, we were walking the line. Then we had a violent move to the downside. That brought you to the Shanghai Accord. That was 2016. That was the hyper indebtedness of China that went and spent and was the super force of consumption and buying in, iron ore from Australia. Australia almost didn't have a great financial crisis. Their property market didn't particularly crash because they were flying because of China. So China created heat in the global economy to that point until they then hit the buffers themselves with a late, delayed property boom that was out of sync with the rest of the world that came afterwards in 2016 that we've been still working off ever since. We reflated, we got up to here, then we started to slip. This is again, the copper price is an indicator of recession. Bang into CV19. From 2019, it was already doing a high speed slump below our regression line that we've drawn. Now we've reflated. We got 7 trillion, which managed to push us a couple of wicks above the previous high. And we've now collapsed below that line. Then we danced around the line. Now we're regularly staying below the line and we're in real momentum to the downside after a failed wick. This is gathering pace. And I am predicting that actually we're in the everything bubble, statism, debt collapse recession. And it could, in fact, be more of a depression than a recession. Even though we didn't get high on the hog, there is a grand cycle of excess that has been accumulated so much that at some point we get the mother of all depressions on account of the status debt collapse. So copper is an indicator for me saying downside. Do I want to be holding the slightly more industrial silver into that? Well, I want to hold some because of unobtainium potentially playing. I don't want to, it's not a trading pot, my investment. It's not like a jump in, jump out trading pot. However, and let's just bring it back one more time. However, I would say on the downside, gold goes down less, copper is going down most. Let's show you that on a shorter time frame as to how we've been doing. Let's just go right down to a daily and have a look at that. And if we just talk about it daily since the last recent highs, that was in just before May, You can see gold is in between, copper is down. If I drop out of daily and go to say 8 hour, how we've been doing in this recent downturn, and you can see silver has followed copper a little bit. I'll try to get a little bit more of the chart in, and copper is absolutely throwing it down. And on the basis that copper is an early warning indicator of industrial lack of industrial demand and a recessional indicator of one type, we can see that was going down and now it's gone into a right spill. And that's part of the reason why I feel silver has kind of been a proxy for in between. It's still a monetary metal, but it will, as the higher beta option, get pulled down a tiny bit more than gold has. So gold made a new high recently and was still going up in an environment where copper was actually grinding down and then accelerating down. So copper was down here. Gold didn't care for a while, walked its own tune for a while, but now a little bit of sell-off. So that's the take. I think I'd prefer to be heavier gold into a downturn than silver because of the higher beta. At the bottom of that downturn, I'd rather have reweighted to silver. So that's not to tell everybody to become major traders inside their investment pot, but where you are accumulating, accumulate gold now and prepare to accumulate silver when we've had the crash news and the blood is all in the streets and all the medicine and the care and the low rates is coming out. That's when you want to pivot some of your gold into silver potentially. I don't know if that's interesting in a setup chat for you, or just around the economics of everything and also portfolio apportionment.
Yeah, that I mean, what you just laid out here, it's a lot of food for thought because on one hand, if we see all these crises happening and we see gold go up, then it may pull silver with it. On the other hand, the industrial side, if you see copper doing good or bad, whatever it might be, it may pull silver with it. So for the silver guy, he's kind of stuck between gold and copper, and which way does he lean on?
Yeah, I'd say going into a weakening economy, the gold weighting is the better weighting. That said, longer run, the other analysis we like to share with you, which is the gold silver ratio, which we aren't stopping doing, and it hasn't lost its relevance in any way. I'm just trying to give a bit more color to things. So if we go to the gold silver ratio and divide gold by the silver ratio, we are currently in an upswinging gold silver ratio, which is pointing out that it's possibly not a good not a good general spell, that we are getting a little bit it's there's a little bit of weakening out there in the precious metals. So the gold silver ratio, let's just get that up for you again on the daily. You can see it has been strengthening, but overall we did see, and I'll open this up, a big correction through our red line. So this is just part of the pullback. So this is not a dump your silver, we're all wrong. It's more for the period that we've already played. How could I have played it better? Bigger gold weighting, smaller silver weighting. Both have gone up. Both have done great. One more so than another. This is, hunting. We did get our crash. Of course, we didn't know it would stay in a range for so long, the gold silver ratio. So this flag range that we've had, it's been very lengthy. At any point, you could have spilled out of that. It kept getting bounced off this level countless times. You can't know. So you also have to forgive yourself. You're never going to be playing a perfect, 100% game each time. It's the uncertainty. And this is a beginning of a better overall silver performance. So it's not to say silver ain't going to come running hard. I think it will. But I would just say if we go into the downturn part of a recession on the copper side, I would favor having a bit more gold. On that point, I want to add another key variable. So we're looking at all the variables and all the hats that are spinning. And I'm going to take you into the fiat realm. The dollar's had a weak spell. And that's also what turned Bitcoin. You saw this rising wedge here. So this is the Dixie. The dollar had a weak spell over here, broke down out of it to the downside. It had caught us by surprise how far it fell and how hard it fell. ran that low, Patrick, and that's was quite a steep decline for for us. So, and I'm not sure it's all over. We're getting a little bit of a rally here now, which is pulling gold back. But overall, we are seeing weakness of the dollar against a couple of currencies. So let me show you this because this will be interesting. And that'll also mean it'll bring back. I don't expect gold to fall too far in this period, having just made highs. If we do the pound, for example, recently just got a new World Economic Forum leader called Keir Starmer, and it seems they're going to afford him a bit of a honeymoon period by my calculation. So I have done a YouTube on this that I will releasing on the currency side, and we see the pound going up potentially to 1.4. So just showing you this draw here, a little bit of a squeeze, volatility squeeze. And this is pointing to dollar weakness. I'm not here to sell you the pound. We're talking precious metals. But if the pound is going up to 139 is the target with a little bit of an overrun, the round number of 140 could be taken. We've seen the squeeze coming. That's interesting, bit of strength for the pound. Were we to get up, pause for a while at our second interim, muck about a bit, and then go through, that points to a pretty offish stage for the dollar. The dollar's having a couple of candles of strength just after our first interim is run. So we expect a rest after each interim is run. That's the first, that's the second, that's the final target. So we've broken out. It tells us pullback time. It's exactly what we expect. That could be a very good for those that are FX traders, FX trade. But of course, this is also going to be good. This level of dollar weakness, dollar is the God market of fiats and faith-based system. So if the dollar isn't doing well, the euro gets a better bid, the GBP gets a better bid, the yen recovers on the carry trade, which is what we're also seeing, and gold will come back strong and make new gold dollar highs after this pullback period. So you could still, despite the technicals on the gold dollar looking okayish, a bit of a broadening structure and having a bit of a pullback. If this plays out, it's only just begun, bear in mind, and this represents roughly a 8% devaluation of the dollar to the pound, an increasing pound to the tune of around 8%. So that's interesting to us. And we're seeing the same thing, but not as aggressively so on the euro as well, Patrick. So if we're seeing dollar weakness being for a longer period, it's not just this dollar weakness for a week or even a fortnight. You could be dollar weakness. This could be a theme of this quarter playing out with pullbacks and pushbacks all the way, but generally shedding value. Let's show you that Euro USD, which is such a big component of the Dixie. Similar structure, and that tells us it's the dollar that is drawing this structure because it's two different currencies we've done. But again, you've got a squeezing structure, quite flat bottomed, we would say, quite steep off the top. So it is fairly low slung. But despite that, we've done a feign and break trigger, having a little bit of a pullback into our funnel now. But that's a good walkout move. That points to 116s and a half at its target run. And that's about 6%. So not as much as the pound, but also showing weakness for the dollar against the euro, if that is to continue. So we've got two major currencies and dollar weakness. So taking it back all to gold, what does it mean? We could have a weakening. Normally, when you get a recession, you get a strengthening dollar. Everybody runs into T-bills, American T-bills. The global macro hedge fund money buys bonds in America and grabs his yield. That sees an inflow into dollars, dollar up, and a bid under treasuries. But 40-year bull cycle on bonds over, the typical Pavlovian response no longer there as strongly as it normally is, because there's uncertainty about the ability to keep financing debt markets a new trillion every 100 days. And by the way, a recent interview we've just done that will be going out later today on Trump and what's the Trump trade. Watch that on the Market Sniper, but I'll give you a few bullets points. The interesting thing is Trump isn't inheriting the same economy he inherited after a second term of Obama that was fiscally quite lean. that had a debt deficit of 3.2. He's inheriting a Biden 6.7 debt to uh, GDP ratio. And that will see him getting a much worse economy. And he's already committed his 2025 tax cuts to be extended, which means he's 4 trillion in the hole and he has to find 4 trillion. And he's saying he'll do it by trade levies on China, which is only 13% now. It's down to 13%, putting 60% charges on them and 10% on the rest of the world. That won't give him 4 trillion. That'll only give him about 2.5. And it's going to start a trade war that doesn't end well for him because it will be tit for tat. It will be contraction. It will be disinflationary. It will be very bad also for the Mag 7 that are the main drivers of the US economy. Don't forget the Swiss National Bank, literally a hedge fund, a global hedge fund now, is a big holder of Apple stock and the Mag 7 and is a net buyer in there. So the money that comes into America might not all be coming for the bond market anymore. It's come for the super pump of the statist oligarchical monopolies that pay very little tax and for which the European Union has been saying we want a 15% tax minimum on all corporations. And then whilst they'll love to do that on all our small businesses, they're eyeing up Google, Apple, Meta, and all these guys that are doing the double Dutch through Ireland and Holland and paying a fraction of 1%. That's not good for the stock market. The Trump trade being the stock market goes up, taxation goes down, feel good factor, all of that. There's no room for it. And the way he's proposing to pay for just maintaining what he already gave you for Christmas 2 years ago, 2 election cycles ago, he's already in trouble and has to find more money. And his plan is going to likely cause a trade war, which is also further disinflationary. So the whole Trump trade and the whole outlook in the event that he becomes president is not supportive for boom like it was a bit of a boom like it was before. He's picking up a poison chalice that is deeply indebted. A further point, Yellen has been rolling debt on incredibly short term. 75% of the numbers have been on short bills debt. And that means those all come around to be refinanced on Trump's watch, on top of the fact that he needs new money. It wasn't, they've been trying to protect the long end of the curve, so they didn't want to over issue long end debt. So there's utter manipulation, that all forms of chicanery and trickery that only kick the can, but eventually you get to that point where you can't hide that you've been doing short-termism planning. And that debt is going to roll now into short time frames. So that's quite a lot for you that you might want to unbundle. But that's gold. And I think that dollar doesn't necessarily do that great in that environment. And I don't think the stocks do either, Patrick, in that environment if we're going disinflationary.
Okay, yeah, that is quite a bit to unpack, but all good, all good. Francis, I think what I'll do here is I'll create a part two. This first part being, where we talked about gold, silver, copper, Bitcoin, and such. And I think what we'll do is we'll get into more of the Trump trade and a few other things. So if that's okay with you, can we continue for part two?
100%. Crack on. Yeah,
Okay, so Francis Sun, again, I want to thank you for being here, and we'll continue on with the part two.
my pleasure.
Before we head out, can you tell us how we can follow you on social media and follow your work?
There's real opportunity in every crisis. The bigger the crisis, the bigger the opportunity. The traditional financial advice is the wrong advice for the era that we find ourselves in. To really do well, and the opportunity to do exceptionally well in a very short period actually is produced in high crisis periods. In fact, it's the Chinese that have the word for both crisis and opportunity as one, in one phrase. And it is, you have to be in such a position that the coming crisis is going to be the making of you and your future generations, which it will give you the opportunity to do. And we are here focused specifically on reset economics and the reset times we're in. We follow the charts, we get the setups, we take the trades and make the investments. And we also put in place not only how to make the money, but how to protect that money once it's made, and you need those things before you become wealthy. So one example is we have a full offboarding solution for crypto for those that might be participating in a future alt run that's coming. These tokens will be going up immensely because they're part of the statism mechanism they need to put all your property on blockchain and do everything else. What happens though, at the end of that run, you will find huge capital gains tax bills on that. And same for gold potentially. They might try tax you out of your assets, property and homes. You are rich. Look at the nice home you have. Other people are on the streets and sleeping under bridges. There's going to be a culture of envy politics. It's going to be very Bolshevik. They chased after the middle classes and they crushed them. We are focused on this to give you real opportunities of existence where you will have a better life, retain your wealth, and maximize it during reset season. That is our our primary focus. And to do that, just pop over to the YouTube channel, The Market Sniper or The Crypto Sniper. Or if you'd like to talk to us, book a call on themarketsniper.com and find out a little bit more about what we're about. Thank you for having me on. There's awesome, real opportunities out there. But you have to acknowledge the night to see the brightness of the day in terms of those opportunities that are being presented. And that's our sole raison d'etre to help you do that.
Amen to all of that. That was the market sniper, Francis Hunt, sharing his views and insights on precious metals and the economy. To see more of Francis's work, go to www.themarketsniper.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.